Hello everyone, I'm Jim Cross from Village Missions. I've been talking to our giving partners about the new tax law, and to hear most people tell it, the new tax law is bad for churches and ministries because fewer people will itemize deductions. Well, I'm here to tell you it's not all bad. In fact, the charitable deduction is the one deduction that escaped tax reform, not only unscathed, but actually enhanced. The news about the charitable deduction is quite ironic, actually, and I want to talk about it in depth. Now, if you are accustomed to itemizing deductions but concerned that you might not have enough to itemize starting in 2018, I want to give you a few tips that might help you maximize your deductions in future years. So, we're here to do a short series of videos to help you be more tax savvy with your giving so that you can do more for your church and your favorite ministries. We're here to talk about tax savvy giving. All right. So in December, Congress enacted the most far-reaching changes in the federal tax code since the Reagan administration. Every taxpayer is affected in some way by the sweeping changes in the federal income, estate, and gift tax codes. So today, I want to just summarize the changes in the deduction structure, just do a quick bird's eye view, and talk about how this will affect your ability to itemize. Now, I'm going to be very general, so I need to say right up front that these are just the general rules, and your mileage may vary. So make sure that you sit down with your own tax professional and talk about your specific situation. So we'll take a look at some simple yet powerful ways to manage your giving in order to preserve the itemized deduction. The biggest change that everyone will notice is the elimination of the personal exemption and the increase in the standard deduction. Here on this chart, I outlined 2017 and 2018 side by side. Now, the standard deductions are almost doubling, and the personal exemption is being eliminated. You can see in the first column, let's just use married filing jointly, for example. The standard deduction in 2017 is $12,700. That's doubling, almost doubling to $24,000. And the personal exemption is going away. So in 2017, someone married filing jointly would have a standard deduction and personal exemptions of $20,800. That's the $12,700 in standard deduction plus two personal exemptions of $4,050, totaling $8,100 for a total of $20,800. That's going to be very, very simple in 2018. It's just going to be $24,000, and you see that's going to be an increase. You can see in the dark section in the middle that for 1 and 2 member households, the total is going up overall. So what does this mean for households with more than 2 people? Well, if you have more than one dependent, don't lose heart, because the child care tax credit is being sweetened quite a bit. In 2017 and prior, the child tax credit could be used to reduce taxable income to 0 if possible, but it was not refundable. In 2018, the child tax credit is doubled to $2,000 a year per qualifying child and will be refundable up to $1,400. In other words, even if a taxpayer has no tax liability whatsoever, they can get back $1,400 for each qualifying child starting in 2018. And this is an improvement over the additional child tax credit. You may recall there is an additional child tax credit of $1,000 that was refundable for some taxpayers. So this new structure is an improvement for those taxpayers. So we've looked at this scenario for our typical village missionary families with children, and I think most families are going to come out ahead under the new structure. But please take this to your tax professional, maybe after you've done your 2017 taxes. Ask about some forecasting for 2018 to help you prepare for tax season next year. So I'd like to take a look at itemized deductions and see what has changed there. The Schedule A is going to look a lot simpler in future years. At the top is the medical expense deduction, and currently anyone who has high medical expenses can deduct the portion of those expenses that exceeds 10% of their income. So in our example, a couple who earns $40,000 in income and has $10,000 in medical expenses can deduct $6,000 of those expenses. The new tax law increases the deductible amount to what is over 7.5% of adjusted gross income for 2017 and 2018 and years going forward. In the above example, this would mean a $7,000 deduction for those taxpayers. The next items that got a lot of attention in the new law are the deduction for state and local taxes and the mortgage interest deduction. The law caps state and local tax deductions at $10,000. What began as an accommodation to high tax states with onerous property taxes and expensive homes morphed into a combined deduction for property tax, income tax, and sales tax to take into account various states with differing tax structures. For mortgage interest, the final legislation caps the mortgage interest at $750,000, but only for new home purchases. For mortgages taken out before December 15th, 2017, the limit is $1 million, and there is no longer a deduction available for home equity loans. For charitable giving, the new tax law is especially good to generous givers. While some deductions were repealed or curtailed, the charitable deduction came through the process unscathed and was even enhanced. The charitable deduction is the only widely used deduction that was not limited under the new law. In fact, the tax benefits of making charitable gifts have even been expanded. How has it been expanded? The new law expands the adjusted gross income limit for deductibility of charitable gifts from 50% to 60%. That's a 20% increase. In addition, the Peace Amendment has been repealed. That was the amendment that phased out itemized deductions for high-income earners. Now, here's the ironic part. The charitable deduction is the one itemized deduction that you have complete control over. You get to decide when you give and how much you give. Those decisions are mostly out of your hands when it comes to medical expenses and taxes. You don't decide when you're going to get sick. And in the above example, we use $10,000 of medical expenses for folks who make $40,000 a year. That would be a terrible position to be in, and I hope you never experience that. So again, you don't get to decide when you're going to get sick, and that's not a deduction that you want to be using. And as far as taxes are concerned, you remember all those people who tried to pay their taxes early at the end of last year? Some of those folks are going to end up disappointed. You can't take a deduction for prepaid income tax, and early property tax payments may not be deductible if the property taxes hadn't actually been assessed yet. So the charitable deduction is really an amazing thing. The federal tax system has recognized the value of individual charity right from the very beginning. In 1913, 105 years ago, they know that a charitable dollar in the hands of a private individual is often spent more effectively, and Americans are the most generous people in the world. So, let's shift gears and talk about folks who are on the cusp of being able to itemize deductions. What happens if you're on the edge? Well, you can time your deductions by adjusting your charitable contributions. If you're on the threshold of itemizing, you can bunch your deductions. Give 2 years of gifts in 1 year and then alternate years. Or you can make a deposit into a donor-advised fund. So what is a donor-advised fund? It's an account that's set up by you and held at a charitable foundation. When you make a deposit, you take a full tax deduction in the year of the deposit. But then you can parcel out the gifts in future years. This works really well in years when you have a windfall and you plan to give some away. Maybe in the year that you sell a business or you retire and receive a large lump sum payout. You want to make some gifts, but you haven't done your homework. And a donor-advised fund is a place where you can park your contributions and then complete the gift in the future after you've made some decisions. We recommend that our donors work with National Christian Foundation because they share our kingdom values. You can do all of your giving in one place and have the convenience of getting one tax statement at the end of the year. Here's a page from their website where you can learn more. We recommend National Christian, but you can also set up donor-advised funds through all the big brokers. Fidelity, Vanguard, Schwab, they all offer donor-advised funds. Tax-savvy giving is not just about giving at the right time. It's also about giving from the right assets. Last week we talked about giving from an IRA. This week I want to talk about giving from appreciated assets. With record investment gains in 2017, consider using appreciated securities to do your giving. If you've owned a security for more than a year, you can claim a deduction for the full market value at the date of the gift. And you do not have to recognize the capital gains. The combined savings of both regular income tax and capital gains tax can make giving securities especially attractive. A donor-advised fund can also accept deposits of appreciated securities. So when you think about giving, I encourage you not just reach for the checkbook, but look at all your assets and consider how you can do it in a tax-savvy way. Perhaps you have a rental property and you're tired of being a landlord. You'd like to get rid of it, but you don't want to face that tax bill. You can use the benefits of the tax law to avoid tax, provide a stream of income for your family, and bless the churches and ministries that you care about. See, this is another reason we really like working with National Christian. If you have a property, whether it's a second home or stock in a closely held business, whatever it is, National Christian has the know-how to maximize the tax benefits to bless you, your family, and God's kingdom. You know, our tax laws make it possible for generous people to do great things. But we have had some challenges to our religious liberties in the past few years. The current administration has sort of brought a reprieve for the time being, but can they turn back time? Probably not. That's why I encourage you to do your gift planning today. Larry Burkett used to be fond of saying, do your giving while you're living so you're knowing where it's going. This is the perfect time to be thinking about how you will leave a legacy of generosity. If you have any questions about how to be a tax-savvy giver, please get in touch. We are honored to help you. We're honored to help you however we can. So thank you for listening, and I look forward to speaking to you again real soon. And I look forward to hearing from you personally. Thank you.